Yeah. Two. Yeah. Aye. I'm jacking the beat, you calling the cops. The yapping is cheap, I call you the ops. The rapping is heating, it's all cause of pop. You get a leak for the ball, get a drop. Feel like I'm wrong when I double it back, cause I'm making it harder to catch that. But I covered the ticket, I call you to visit. You tipping and hit up the cash app. Baby girl, been around for it, yeah. In the old days, I was stuck in old ways. Never really trying to flip the old page. Young man tripping at an old age. Thinking I was flicking, had a low wage. Late the bro days, then a slow praise. Thinking it'd be different, it would gon' change. Then it really didn't, it's a cold game, yeah. Ay, all I really wanted was the money in the pocket. Got over money, but the money ain't the topic. Like Bill Doe and the money gotta stop it. Kid need food and the whip need juice. I'ma get these views when the
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, baby? It's your partners looking so fresco clean, man. You see that thing, baby? Now take that picture for your mom and them guys. So welcome again to another edition of the Real Estate Live Friday training, man. Cliff, man, say what's up with you, man. What's going on with it? How was week, man? How was it, brother?
Man, good week. A lot of stuff going on, a lot of moving parts. The Fed raising rates and everything. So, but yeah, overall, good week, man. Got that bag, so we always winning.
We got the bag. That is the most important thing, y'all. We got that thing, man, y'all. Man, how baby girl doing? How baby girl doing? She doing all right, man?
Man, it's doing amazing. Doing amazing.
Yeah.
The little girl is got so much energy, loves her
Yeah.
daddy. You know what I mean? Taking up all my time, but I love it. Loving it.
Yeah. Y'all, on this one, guys, man, you're going to want to share this to everybody. So no matter what platform you're on, share this one, guys, because me and Cliff going in on the Fed raising rates and also luxury apartment complex investing. What's going on in that space, man? So, guys, let's dive into this thing. You know how we do it every single day, man. We look at the current market analysis, guys, man. Let's dive into this thing, man. Man, the Fed raises rates again. Now, me and Clippers have had some great dialogue concerning this whole Fed thing, guys. We could continue that whole discussion, man. But let's see what actually happened, guys, and the ramifications of them actually raising rates and how it affects you. Okay, we're gonna bring in our partners, man, from Valuetainment, Patrick McDavid, and man, we're gonna dive into this thing real quickly, man, and see exactly what they're talking about, man, and then we'll go into this thing. Let's see what they're talking about. Here we go.
Fed rates interest rates to 22-year high, leaves door open for more. This is a Bloomberg story. So here we go. Federal Reserve raises interest rates from 5.25 to 5.5, highest in 22 years. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate, says Jerome Powell. Powell highlights encouraging signs of inflation curbing, but warns that policy has not been restrictive enough for long enough to have its full desired effect, indicating a possibility of further tightening. The FOMC upgrades economic growth to moderate from modest, while expressing concern over elevated inflation in service sector categories due to tight labor markets, and expects credit tightening to impact the economy following bank failures. Tom.
Wow. So we kind of saw it coming, got another quarter point. The Fed rate now 5.5. It sits there 5.25, 5.5. There's always a little tiny spread, which means it's just putting more pressure on everything. But what he said was very interesting. He said, remember, we've been waiting for the Fed to interpret figures. Well, and listen to what does the Fed say, that he thinks it's a moderate problem or a modest problem. And we hang on the words of the Fed. Well, now he's saying it's going to be data dependent. And number one, he said, inflation rose by 3%. Through June, but that was only 1 month, and it was really like closer to 4.5. And getting down to 2% is a long way to go. And then he said, when we get together on September 19th and 20th, remember, this is the longer summer break for the Fed. We're going to be all the way September 19th and 20th before they get together again.
Yep.
And we're just sitting here 20th of July was just a week ago. So it's effectively almost 2 months. And what he said was, I will have 2 more job reports and 2 more consumer price reports in hand by that gathering. So what he's saying now, basically, is the stock market is going to be able to predict and manage what the Fed says in September, because it's going to be a data-driven approach. So we don't have to wait for Jerome Powell to say, I feel this, or you know how we hang on his words, modest, moderate, major. What word did he use? Now he's saying it's going to be data. So we're going to look at those job reports and the consumer price reports. If the job report is too hot, if the consumer price index is too high, then he's probably coming with a 1/4 point on September. But the market, you're going to see the market react as soon as the reports come out, because it's going to tell the market what he's going to do, because he says we're going to data driven. And I think is a sign that things are getting better in the stability of the economy. He also said, I don't really see a recession this year. I think we've been able to surf this thing out a little bit, which means maybe everything the Fed did here, even though we had a lot of layoffs, people were looking for work, maybe we've gotten through this thing. And so I think...
what's a 30-year fix right now?
30-year fix right now. So let's go to mortgages.
I want to say it's like 6.8%.
Rob, you have that? I sent you the link.
6.8?
Well, watch this. Well, what would you expect would happen overnight with the rate goes up a 1/4 point? You expect to be up a little bit. It was a link I sent you from Google in your email. Anyway, so I just pulled Florida. 500,000, 20% down, state of Florida mortgage, credit score 680, 699.
Wow.
That is where the majority of America is, or just under. 30-year fix, 7.95.
What? 7.95, $500,000 mortgage.
What?
20% down.
Correct.
680 to 699, 7.95.
Correct. As of this morning, and you can see the little spike up right there that happened overnight. So we're still going to see those rates, between 6 3/4 and 7. And people say, well, I'm people will write in the comments, I got a 6 1/4. Yeah. What'd you pay? 2 points. Oh, okay. Well, you really did pay the rate, but the points just make your payment less artificially because you paid the points up front. So that's where it's going. So that's where the rates are, but it's still going to be heavy on mortgages, which means, as we've been talking about homes, the supply is still going to be getting this pressure.
Well, quick.
So Cliff, man, I wanted to kind of play, man, without interruption, and guys that on Instagram, guys, they just shut it down. No problem. We'll just re-air this one again, guys. I don't know what's going on Instagram. It must not like what we talking about, but it's all good. We're talking about. But at the exact same time, here's my thing. What are your thought process, man, on what's going on with the Fed?
I think the Fed is doing the best they can. They are in a situation they've never been in before. So they're trying to figure it out the same way everybody else is. Now, I've said this for a little while. I think the Fed is getting it wrong consistently.
Wow.
Getting it wrong.
Wow.
That's why I actually bought some more stocks today, because I still see the market moving higher, because we've been at the end of this rate cycle, right, where they're hiking rates. And I think it's about to go up. I think they're going to start cutting. I've been calling it. They're going to cut it in the first quarter next year.
So you said first quarter of next year they're going to cut it?
Yeah, I'm thinking some January, February, you're going to see cuts.
Okay. Even after they're talking about raising the rates again in September.
Yeah. Because I think they're not seeing the rollover of we've seen month over month inflation drop.
Okay.
So when you have the inflation rate at 2.5%, you're raising. The reason why you raise interest rates right then is basically he's trying to say to everybody else, look how serious I am. Y'all see how serious I am? I'm raising rates. I'm serious. He's trying to prove to the market that he wants to keep it low. I can go back into history on it because they've done this before.
Okay.
where they did the exact same thing. Inflation dropped.
Okay.
They said, cool, they cut it, and inflation
Okay.
came right back. They don't want to see that happen this time, so they're raising rates a little bit higher to make sure, but then they're going to cut.
So what you're saying is you're saying how the Fed is interpreting the data, they're interpreting it incorrect.
Oh yeah, everybody knows that the numbers they use are wrong. They use past data. They use
Okay.
past data. They're using the wrong information. If you use current inflation, and I sent it. If you go look at Trueflation,
Okay.
current inflation is at 2.5%.
And what are the metrics that they're using to come to that inflationary rate?
They're bringing in all the different metrics from housing, transportation, utilities, all that kind of stuff. They're bringing all that in and then coming up with a measurement at 2.5%. For example, housing is in deflation right now. It's
Yes.
deflating. It's not.
Yeah.
There's no inflation in the housing market. It's dropping. Prices are
Yeah.
dropping. So there's
Yeah.
deflation.
Yeah.
So, and what's the biggest metric they use in inflation?
Mhm.
Housing. So if housing is the biggest metric and it's deflated, that means the market is moving down.
So let me
Or,
ask you
or
this
sorry,
question.
right. Yeah.
Let me ask you this question.
hmm
Whenever they are looking at the inflationary rate, what are they leaving out?
Oh, when they use core, oh, they leaving out what? Gas, food, you know.
Oh my God! See, when I hear, and for guys that are actually on Instagram, I mean on Instagram, guys, again, I don't know what happened, guys. Instagram just don't like us at all. So I am sending over to you guys the link to the YouTube page. Guys, come over there. Instagram, they don't like us. They don't like us at all, man. So give me 1 second, and then what I do is I'll get to my comment real quickly here, Cliff. Here, here, here's what I'm saying. It is here is I'm looking at what they are not, what they are leaving out, because if I am wanting to understand what's going on, I'm going to at least know if I want to know what the raw numbers are.
hmm
Stop treating me like a baby. Just give it to me.
I
You know what I'm
feel yeah.
saying?
I
Don't
see what you
don't take out energy and don't take out the food because
said.
I'm having to pay a
Right.
high price point for energy and the food. Give it to me. Don't tell me, don't pee on me and tell me that it's raining. You don't about just let it rain. Just let it rain. You know what I'm saying? So my whole thing is this here is when I'm hearing what's going on, I'm like, no, I ain't rocking this at all because I'm looking at your actions. Now what I'm hearing is we're interpreting it this way. So now I'm like, okay, what's driving your interpretation disciplines here? Is it to tell the truth or to screw me over? Because
Mm,
right now, um, not saying that Chairman Powell is a bad guy, 'cause I don't know the guy at all. Period.
hmm
What I'm saying is, if the administration is taking things out, I'm looking at you sideways.
Oh yeah.
Would you agree or disagree?
Oh no, I agree. So I think you got to figure out what's the aspect and goal you're looking for.
Okay.
If you want to know how the real market is doing, man, we don't have a real market. You trying to find something that don't exist. You know that ain't none of it real. We playing in funny money times, right?
Yeah.
But if you're looking to see how can I make money off the market,
Yeah.
what way is the market going, and can I predict it to some
Yeah.
degree
Yeah.
in order to capitalize on it? That's where I think the opportunity is because right now in real estate, the interest rates for the mortgages are, I think, around 7%,
That's correct.
8%.
Yes, they are.
So nobody's buying. So
So
it
so so here's my question though. Then, since no one is buying, Cliff, here's my questions. How should we interpret that? Because people ain't buying, so that
mm,
means that there's less
right,
inventory on the market right now, right?
right.
And for someone to go out and buy a house, they got to borrow at 7.5%, 680, 720 credit score, 7.5%. That's crazy. How is that going to rebound this system?
It won't. But you have to understand the point of the interest rate hikes is to slow down the system.
I agree with that. I agree with that too. But slow it down from what? For what?
Because it was inflating too much money. The money was growing too fast. The M1 money was growing month over month. So that's
So stop right,
M1.
stop right there. How was the money growing?
The government was just getting it.
You know what I'm saying?
Yeah.
You know what I'm saying? I gotta ask these questions. So I gotta stop right there because that's what's driving the inflation. Not the consumers, is all government. We're talking about the executive branch and legislative branch, just printing their hearts out. Here's my question. Here's my question. Will the politicians stop printing?
Oh, no.
So if that's the case, it doesn't matter what the Fed chairman does, it means nothing because the buffoons won't stop printing.
Okay, I got a question for you.
Holla at me.
What they were printing, let's say 5 years ago, before the pandemic, they was printing, right?
Yeah.
What was the inflation rate?
It was what? They're just doing Trump's term, right?
Yeah, let's say during Trump's term, yeah.
Okay, it was what 2%?
Right. So you just said it. They were printing money, but it was still a 2% inflation rate.
I'm rocking with you.
If the inflation rate right now is around getting close to 2%, they can still continue to print money. They're gonna print money. That's a given. They're gonna do that. That's all day. That's a lot.
So if that's I'm rocking with you. If that's the case, though, what were they able to do also to curtail inflation? Because inflation's been here for a long period of time. Back when I was a little kid, I could go out and buy some gum for 25 cents. It ain't happening no more. So inflation is here. So how were they able to siphon out what the masses were feeling for what was coming, which is inflation? They were able to what? Sell the debt away or send money across the seas, right? Here's the problem with that. Ain't nobody buying our debt. The Fed is originating these bonds and then buying them back for themselves. So that's the problem. That's why Ukraine is so important because that's a way for them to send over inflationary dollars. That's what they're trying to do. China ain't buying our debt no more. Japan barely is. You know what I'm talking about? These companies are not buying our stuff anymore. They're not buying the debt no more because it's just too inflated. That's why the Fed is expanding their balance sheet. That's what I'm saying. It doesn't matter what he does at all. What's going to happen is just here until these buffoons up there on Capitol Hill in the executive branch, no matter if you're a Republican or Democrat, stop, be more fiscally conservative like the consumers are, operate by a budget, so to speak, not a blank check. This is not going to stay. This is going to continue to happen. Would you agree?
Yeah. Well, we're always going to have, if you just do the math, you have 3%, and that's the 3% they're saying is a number they made up based off metrics they made up. You know what I'm saying? That ain't the real inflation rate. Probably they said it's 3. They said last year was 9%. It was probably 30%. That's what I'm seeing. You know what I'm saying? I saw some stuff double, so I didn't see that on no metric. You know what I mean? It said inflation was 10%. I said it doubled. The eggs went to $15 for a dozen.
And then when the Bureau of Labor and Statistics began changing how they gauge the inflationary rate from doing it every other year, every 2 years, to every year, so you can brag about what you have not done, that's trash, bro. That's trash.
You can't give people the ability to change the metric that they are measured on. You know what I'm saying? If you measuring me how fast I am, I'm gonna go, well, you know what I'm saying? I'm gonna be like, you know what? Actually, the slower you go, the faster you are. I'm changing the metric. You know what I'm saying?
So Cliff.
Yeah.
Concerning what's going on in the market, because Cliff is a licensed appraiser guy, so he's actively appraising properties. What's happening in the market now that we have this? We've had this news for a long period of time, but now they're raising the rates again. What effects is it going to have on the market from an appraiser standpoint?
I think we're gonna see more properties start dropping in value. They've been so they kind of slowed down because they found the interest rates kind of settled out a little bit.
Yeah.
With them raising interest rates again, they're gonna
Yeah.
pop back up, and we're gonna see it stall, if not drop. I'm seeing houses uh for prices I didn't think I'd see. That's going to
Mm.
continue for probably another 6 to 8 months.
Okay.
And I think that's part of the Fed's goal because really the biggest problem that they had was inflation was housing. Housing was getting out of control. They want to see housing prices drop. That's their goal. Once they start seeing the housing prices drop, then I think they're going to start kicking down the interest rate so that they hit an equilibrium. Like
Okay.
I said,
So
I say that in about 6 to 8 months.
what equilibrium are they looking for?
Probably going to end up right now. You got housing, probably let's say 8% for interest rate, right?
Okay.
They see that they want to get it down about 3 basis points. They can get it
Okay.
from a mortgage being at 8% to 5%. They win.
Here's that in my opinion, this is an invest and hope strategy. Because them jokers is not gonna stop printing, bro.
Mm-mm.
They're not gonna stop printing, man, because they can't stop printing. Guys, they cannot stop printing. They can't. And so to me, this is a dog and pony show. It was a dog and pony show concerning Trump, dog and pony show concerning Obama, dog and pony show concerning Bush, dog and pony show concerning Biden. It's a dog and pony show of them trying to brag about what they are not doing.
Dale, why don't you break down to the people why do the rich get richer through inflation? Why?
Because, go ahead.
Right. Now, I was
Go
saying,
ahead.
go ahead, do what you do.
The reason why the rich get richer, like me and Cliff, the reason why we don't say this braggingly, this is what we do, is the rich, they use debt to acquire hard assets, whether it be a business or real estate or gold or silver, right? Now, those assets produce income, right? And so they use really cash to buy assets that generate income for them. By doing that, guys, they get tax incentives for doing that. So the tax liability is gone. Number two, those assets are increasing in value, right? Because they're buying deals. They're not buying on retail. We don't do that. We buy below wholesale. Why? Because we can increase the value of said asset to a higher price point than what we acquired it at. That then generates an income, whether it be a capital gains income, i.e., flipping a property, or an income stream of cash flow, like a rental or financing income. That's how we do that. And also, because we understand the code via our team, even our cash flow is written off. So we pay zero in taxes. We use cash to acquire an income producing property below wholesale, increase the value with the debt, refinance to longer term debt, paying off debt with debt, take home money tax free up front, which is great on the refi, and then either flip it or produce an income stream via rental or finance income, which through our wealth management strategy, we write off all those taxes. So we pay zero in taxes, but we increase our net worth and that cash flow, all tax free. Did I cover it all, Cliff?
Yeah, man, that's spot on right there. The reason why I wanted to bring that up is because the rich people use the way the system works to benefit them. Now, you could not like the system. We can argue all day what you think about the system. The
Heck yeah.
question is with what's available, are you capitalizing on the things that you can for you?
Yes.
We know hard assets go up in value. So what
Oh,
do? We go and buy hard assets. It's
yes.
that it's that it's that simple. Don't overthink it. Your goal is to buy as many hard assets with leverage as you can. You want to be smart. That's where it takes education.
Yes.
But your goal is to buy as many hard assets as you can, and you
Yes.
will win the game over time.
It is that simple, guys. We always say insure, leverage, and then protect. Most consumers get mad when the rich get richer. My question to you is: you guys have the exact same 24 hours a day that the wealthy actually have. How are you spending that time currency? How are you doing it? If you're trading time for money, you will always hit a ceiling. But if you understand how to be a business owner to build businesses and also become an investor in hard assets that generate a good income, all of a sudden now you become more bankable to a banker or lender like myself or Cliff. That's why we believe in partnering with investors to acquire more assets, because your net worth goes up as well as ours do as well. And everybody makes income. Everybody wins. It's a win-win. So that now, why me and Cliff do these real estate lives every Friday is we're trying to get you into the room of how the wealthy think so that you can begin to process things the right way, use the right strategies, learn how to locate properties, below wholesale properties, learn how to put a deal together, how to property vet a deal, if it's a good deal or bad deal, whether it be an apartment complex, a single family residence, a condo, or a vacation home, you name it. This is all right now is one of the most best times to acquire real estate. I mean, guys, hear us very clearly. Joint venture investing is the most powerful tool in investing, whether you are the top 1% or at the bottom. I'll give you an example. You see companies like NRG. NRG is a company that they actually acquire electrical companies like Reliant Energy, Ambit Energy, TXU, the big boys. Matter of fact, I believe the stadium in Houston where the Texans play at is currently or is formerly called NRG Stadium. So they are a huge company. Do you know how they actually go out and acquire these energy companies? Through joint venture investing. That's how they do it. BlackRock, joint venture investing. Vanguard, JV investing. State Street, JV investing. Grant Cardone, JV investing. Robert Kiyosaki, JV investing. Me and Cliff, JV investing. Do you see why we say joint venture investing is the most powerful strategy you can actually use? Why? Because the big boys use it all the time. What you're dealing with 100,000, 50,000 up to 1 trillion, 2 trillion. Guys, I know I'm in these rooms, guys. I'm negotiating these deals. Me and Cliff, we're in these rooms. What we're doing all the time is what we're doing, guys, is we are seeing. And guys, to be honest with you guys, can I give you a little bit of inside baseball? You know what? Every investment strategy kind of centers around real estate, the structure of it. The same structure. It's the same structure, just different terms. Would you agree, Cliff?
Yeah. Whenever you start dealing with a lot of basically everybody with money is in real estate. Even if they made their money in restaurants, they made their money
Yeah.
in tech, they made their money
Yeah.
in being a doctor.
Yes.
They all use real estate because real estate is the most consistent form of income in terms of cash flow you probably gonna
Yes.
get.
Yes.
It's it's
Yes.
uh, it's basically like a commodity. It's almost like think of like coal, you know what I mean, like toothpaste.
Mm-hmm.
Simple, right? Everybody brush their teeth, right? It's a commodity. Everybody uses it. House. Everybody needs a place to live. So if you're looking for consistent returns, you go to real estate, and everybody who's got money knows that.
The reason why is because real estate generates consistent returns,
Right.
and also, guys, it's a shield from inflation and taxation. With the right team, my word, with the right team, you understand that Robert Kiyosaki, right? He actually buys apartment complexes, things of that nature, as do me and Cliff as well, also. And what happens is he has very little to none of his money in the deal. Same thing, Grant Cardone, same thing. Why? Because of joint venture investing. The long rangers and real estate guys get eaten up. Long rangers do. But those that actually have strength in numbers via a team, guys, will easily outscale, outperform, and make more money than any loan investor all day long. All day long. Think about it. If you were a joint venture investor with me and Cliff on a said deal, right? Let's say, for instance, we bought 5 properties at $100,000. Cliff, should I show them on the calculator real fast, man? Show them calculator real fast, man. Here we go. Boom. Let me show you guys the power real quickly of JV investing, guys. This is going to be the power of it. Here we go. Boom. All right, here we go, guys. I'm doing it like this here real fast so you can see the entire screen. You're going to let me do it? Okay, there we go. All right, I'm going to get rid of this real quickly. Here we go. Say, for instance, guys, you actually acquire property right now. We acquire property, let's say the ARV, and say it's $200,000. Don't say 100 grand. That's easy. $100,000 is the ARV, right? Let's say, for instance, out of that 100,000, you own 50% of that, right? So that times 50% of that. All right, we're gonna keep it real simple. So again, that's $50,000 in net worth that you actually have now. Multiply that, guys. Let's say if it's you did 1 a quarter, just 1 a quarter. Okay, so that times 4 because you have 4 quarters. Your net worth in 1 year has went up to $200,000. Your net worth, 200 grand. So now you take this network and you go to another banker saying, "Hey, banker, hey, I want to buy a property. What's your net worth?" Here it is. Because a banker does not issue any money based on your report card. It's based on your income statement and balance sheet. You show them this, guys, it'd be great. Now you do this for 5 years straight. So $200,000 times 5 years, right? Now your net worth is $1 million. You double that because now you have $1 million. Now you double that. Double that. So now you can double that now because now you can borrow more LTV. All right. This times another 5 years. That's now you have $5 million. This is in 10 years. You have net worth of that. And let's say, for instance, this is generating because remember, you're actually buying 4 properties, right, a year. 4 properties times $200 a month. No, you know what? I'm gonna keep it simple. 4 properties times $100 a month. I'm gonna keep it real simple for you guys. That's $400 a month. Again, 4 properties for the year. $400 a month times for just 4 properties. That times 12, right? It's $4,800 a month. $4,800 annually. That right there times 5 years. That times 5. Boom, it's $24,000 at the 5-year mark. Annually. That divided by 12. Because remember, you got 12 months in the year. It's $2,000 a month in passive income. $2,000. It took you 5 years to do it. This is just buying 1 property, JV, right? A quarter. Just 1. Cliff, does this make sense, man? I'm off base.
Nah, man, that's the system. It's straightforward. Like Dale said, you need a plan and you need to play the long game. Dale said 1 a quarter. Boom. And and then you get compound. Then it compounds on each other and grows and grows. And that's the game. You just gotta keep sticking to the game, man. It's like playing baseball. As long as you get the ball in the bat, just consistently keep doing that. Good things are gonna come. You know what I mean? So you just gotta consistently keep finding your your 1 house, your 1 apartment, your 1.5. Cool. Now on to the next one. It's that simple. It's straightforward.
That is it, guys. We have a lot of people reach out to us, guys, about partner with us to invest, and we're like, no problem. We'll bring the debt, no problem. Bring the deal. We'll bring the debt, no problem. We're trying to give you money. We're trying to invest in your project. Think about it. You actually have someone like a Cliff Hunter, a licensed appraiser, which means he knows how to determine values, and a general contractor, as well as an active investor. You have me, who I am really a mortgage banker, a private equity venture capital investor, as well as a real estate investor. So you have these minds coming together saying, good deal, bad deal, here's the money. How can you lose? How can you lose? And we're going to buy it at this price point because why? This and this can happen. We need to plan for the worst case scenario. Worst case scenario. If that makes some sense, Cliff. Cliff, does that make sense, man?
Yeah, that makes sense. Yeah, it's two minds better than one. Three minds is better than two. The more people, the more opportunities we get. It all starts working out. So, just like this is an opportunity. I wish I had this. I wish the Instagram wasn't available when I first started like this. You know what I mean? I didn't
Yeah.
have any kind of information. YouTube wasn't big like this. We had some information, but now it's a whole new situation where you can get in contact with people, ask questions, and see how you could do. Dale said one a quarter. I always say one a year. However, you're trying to do it, you can buy one and grow. Uh, I've had it happen to me. Had a property, flipped it, boom, 25K. Had a property. I've had several properties that bought it, held it, grew 100K in equity. Had that happen a couple of times. So everything can change with just a couple of deals.
Everything can change. I mean, everything can change, guys. It really can. Uh, Investing is not it's a team sport. So don't do it alone. Don't do it alone. So Cliff always said you are one decision away from changing your life. Even with me and Cliff. Cliff, tell everybody, man, your first deal you ever did, man. How much money did you make, man? Were you scared, bruh? You know what I'm saying? Tell everybody about your first deal.
Oh man, it's a long story, but I'm gonna try to keep it short. Uh, man, to be honest with you, I was ready. Man, I didn't know much about real estate, and I literally studied for 6 months. I went to RIA meetings trying to figure it out. I had this I met this one dude, I call him the OG of real estate. I met
Hmm.
him, he gave me the final piece. Man, shout out to him, man. He gave me that final piece. And when he gave it to me, in less than 30 days, I bought my first property.
Mm.
I
Mm.
went through the whole process, man. I went through everything. I ended up renting it, selling it later. But I cash flowed for a whole year. After they said they wanted to move out and all that kind of stuff, they moved out, sold it, popped out. I think it ended up being about 24,000.
So
That's
so
not
you made
accounting the cash flow. The cash flow would have made it probably about 28,000, 29,000.
so let me get this straight. Your first deal you made $24,000.
Yeah.
On his first deal, were you
My
scared?
first. Oh, I had no idea what I was doing. I got lucky. I got lucky. I basically got a paint and carpet house.
A
Dale
painted
would know
carpet
this,
house.
but maybe y'all won't unless y'all in Dallas. But Dale, I bought that first house for 58,000 in Fort Worth.
Wow.
Three
Wow.
bedroom, two bath, 1,200 square feet. It was,
Wow.
and it was paint carpet. The rehab was 15K.
Mm.
I
Mm.
got lucky. I got a great deal on my first deal. Uh, but I will add a little bit. That is only because I had made a mistake right before then.
Mm.
And I'll give
Mm.
y'all a little backstory on this. I'll take a couple minutes and let y'all know this is why you gotta know what you're doing. The
Yeah.
first property I actually put under contract was a bad deal, a terrible deal. My first one.
Mm.
I
Mm.
was buying it from a wholesaler. He tried to sell me. So I felt like this is gonna be great deal. Found out it was a terrible deal. I negotiated with him and said, "Do you have any other properties?" Because I put $5,000 down. That's how much I risked. The wholesaler told me, "Man, I got another property in South Dallas. I know you
Okay.
don't like this one. If you take this other one, we'll make a deal." I took
Mm.
the other property deal, flipped that, made 24,000. So I turned a bad
Hey.
situation into a good situation. Man, I was off and
Hey.
running.
Yo, man, that's what's up. So Cliff made $24,000 on his first deal.
Hmm.
24 grand. For me, I made on my first deal. My first deal was a wholesale deal. That was a
Mm.
wholesale deal. It was in 2005. It was in Irving, Texas. And I signed a property. I didn't know what I was doing. I learned about wholesaling, man. They're going to meetups. I had a friend of mine that taught me a little bit as well, named Brian Kennedy as well. And he taught me a little about wholesaling as well. Brian was really big in subject to investing and wholesaling as well as flipping, but his real niche was flipping. So he taught me a little bit about wholesaling, and I wholesaled a deal real quick. Made $3,500 in what in 5 days.
Mm.
And at that time, I'm like, man, I'm rich. I'm rich. I'm getting it in. My second deal I made, it was a seller finance deal, actually. I actually made $10,000 on that deal, down payment.
Mm.
Down payment. So and it was seller finance to a Hispanic family in Irving, Texas. So I said, and I made about probably $300, $200 or $300 a month cash flow on that deal. So the 10,000 was up front, but it was $200 a month after that. So I made $2,400 annually on that cash flow. I was the bank to somebody, literally. I got a down payment. All right, and then I made another $10,000 on a deal that literally paid for my wedding, in the property in South Dallas. That was probably the worst deal I ever bought. It was a headache. It was in the hood. And I had Section 8 clients, man, and they were terrible. They ran through the house. I went through 3 Section 8 people, 3.
Mm.
3, and they ran through that. I mean, they stole the AC units. I put a cage around the AC unit. They cut through that boy, got the AC unit. You know what I'm saying?
Yeah.
I mean, just, and it was a new construction home. So it was a new construction home. It was.
Oh wow.
It was, man. And so I just said, man, it was in a town called Lancaster in South Dallas. I mean, I will never do that again. But I learned a lesson. I learned a lesson about how to vet Section 8 people. Because I think Section 8 is a good cash flow strategy if you have the right person in there and the right companies vetting those people, and with the right asset itself. And I understood seller financing more. That's how I went right into subject to investing, because I began buying properties subject to over and over again. Matter of fact, the property that I actually got down payment from, my second deal was a sub 2 investment.
Mm.
I got the property for $0 out of my pocket. I paid nothing for that property, zero, nothing. They signed to me over the deed, and so I came up with $10,200 a month cash flow.
Mm.
So I know, guys, we get up only talking about the successes, but we've had some failures. Matter of fact, we may do a real estate live on the top 3 failures we've actually had in our real estate investing career. You're going to be surprised. You'll be surprised about this at all. But I think that we've been having some problems on Instagram, guys. We may end up creating a channel on Instagram as far as our own channel as well for us to send out alerts. So we're about to go live. You guys can see us on Rumble or Facebook or LinkedIn or YouTube, because we be having some problems, guys, with Instagram. We were on live and it's kicked us out. Gone. I don't know what happened, guys. But we'll keep doing Instagram until we get our audience back up, guys. But we were going to talk about luxury investment, guys, but we'll talk about that next week as well, because we kind of pivoted to strategy now, which is pretty cool on this one, due to the Fed, to the Fed raising rates. I believe, guys, that we're going to continue to see less inventory. You're going to continue to see cost of a living go up. You're going to continue to see people's wages get stagnant. You're going to continue to see people borrowing more money on their credit cards to help pay for the bills. And then you're going to begin to see a renaissance of people saying, I just want to get out of the houses.
Mm.
Seller financing and subject to investing are going to be the most powerful strategies moving forward. And JV investing, if that makes sense. Cliff, you agree, brother?
Yeah. I think that. I mean, I see. I think the amount of opportunities that are gonna pop up, you just gotta start throwing out some offers. You gotta start getting in the game at some point. You know how everybody says they waiting when things were going good. Everybody said, "I'm waiting for a down market." This is a down market. I don't know if we're gonna get no one like this in the next 10 years. I don't know.
Yeah.
So this may be the best opportunity you're gonna see in a while. So just get what you can. Start the process.
We got a question on YouTube. It says, "Is it possible for somebody just coming in with no real knowledge to still do this with the way the economy is now?" I mean, I know a little from watching you all. Oh, well, Sarah, thanks so much for trusting us with your time. Yes, you can. You can do this. The key thing for you, Sarah, is going to be joint venture investing, because you get to learn as you actively invest with very little risk. There's risk in everything, okay? but very little risk when you do joint venture investing because you actually have a seasoned person bringing the capital and the intellectual property, and you split profits, if that makes some sense. And so, while now all you need now, Sarah, is just education on how to find a good deal. Money follows value. And how do you present value in real estate? Bring a good deal. Now, I know you're saying, Dale, I'm new. Cliff, I'm new. How do I begin to realistically find a good deal? Reach out to us, DM us. Matter of fact, I believe, guys, for those that want to do this as well, we do have a course right here, and this is the cash flow bundle, guys. For those that want more education and be a part of the cash flow club, you're welcome to scan this QR code. We actually have four courses already in this, and it's on joint venture investing, subject to investing, how to put a deal together in 90 days, how to put together a power team. All that is there, guys. All that is right there, and it's for $99. That's it. Our whole thing is we don't want to sell a course. We want to give you guys access to counsel so that you know how to bring a deal, and let's learn while you actually find a deal. If we can teach you how to fish, we never be broke ever again, if that makes some sense. So we're trying to teach you this is how you fish. So can we do 101s? Sure. But at the exact same time, we can invest an hour at a time with you, but what if you actually had the exact same counsel on demand? And as you are listening to us on Real Estate Live free, and as you listen to us when it comes to the courses, because me and Cliff teaching in this course, you'll begin to find an actual deal. And you say, hey, Dale, I got a deal. I said, and we'll say, we got the money. What you got? And we'll walk through if it's a good deal or not. Cliff, man, tell them how the masterclass, when the first time we actually did it, that someone actually brought a deal to the table, and how did that turn out?
Yeah, we had a good conversation on our first class, and people brought they questions to us, and somebody actually had a deal. We walked through it with them, and very quickly we were able to identify all the problems with it. So just from that alone, we saved him the entry fee. Because if he would have gone forward with that deal, I guarantee he would have lost more than $100. Guarantee
Easy.
would have.
He was upside down on the deal, man. What, 40 grand?
Yeah, he was way off. He was thinking he could do the rehab. The location didn't sound right. A lot of different stuff going on with it. So yeah, yeah. I mean, but it went real well, right? We had a lot of people asking questions. We were able to identify some of the problems they had, and then now they could take that information and go, you go utilize it.
That's it. And he was so thankful. He was like, man, thank you guys for showing me that this was a bad deal. Because he was ready to pull a trigger. He was ready. And I just said, man, does it look like a good deal? He said, no. So now what? He said, I'm backing out. So we're able to save somebody a real life deal. And so, and also in the cash flow club, guys, that's what we bring. We actually bring this right here. When you actually buy the bundle, you actually automatically in the cash flow club. So we actually have monthly times where we say, we all come together as a real estate investing community. And we'll say, all right, guys, who has a deal? What problems are you seeing? Because your market is different than my market. We're in Texas. You may be in California. You may be in New York. Those three areas are three different areas, total different metrics, total different disciplines, total different regulatory policies as well. So 3 different markets actually has three different type of strategies. For instance, in New York, when it comes to leasing a property out in New York, guys, I think it takes 24 to 36 months to get someone out of the property. Leasing in New York, the state of New York. It's ridiculous. And so it's in Texas, you out in what, 4 days? 5 days? You out in what, roughly 20 days? You're out. It's a lot more robust in Texas, Tennessee, Mississippi. It's a lot more robust. That makes some sense, guys. Cliff, you agree, man?
Yeah, and this is the kind of the info we get into, but that's just landlord friendly states.
Yes.
right? And we could break down how important that is when you start investing, because until you have a problem, you don't realize you got a problem. You know what I mean? So
Yeah.
we help you. We're here to help you identify those problems before they're problems, so you can
Yes.
avoid them.
And notice, guys, you're going to make a mistake.
Yeah.
Be okay with making mistakes. You are, because you're dealing with different entities that's involved. You're dealing with different strategies involved. Deal with people can be difficult. Leases can be difficult. Finances can be difficult. Borrowers can be difficult. Be okay with problems. Just know that you have an inner circle of people within the cash flow club. You can say, I got a problem. How do I solve this problem? And just like in the master class, the problem was solved. Say they do money. That simple. So, guys, we are doing another real estate masterclass. We were trying to do it at the end of this, at the end of July, and then work out it all. I'm kind of in the middle of closing a pretty big transaction, so I'm gonna get with Cliff this weekend, and we're gonna talk about what day and time in August works well. Now, the last masterclass, we did not market for that. We did very little marketing. I'm sorry, we did like 2 or 3 days of marketing, very little, and with no marketing, literally no marketing, we had a full house. So, guys, this one is going to be very full, okay? Probably 20 or 30 people. It's going to be very full. And so we're going to talk about a lot of things: new construction, buying and flipping, buying and holding, landlord-friendly areas, finance-friendly areas, what's going on with the market, how to counter move bad policies. We're going to go through all of that information, all of it. It was for 2 hours. We got bombarded with a lot of questions, Cliff. 2 hours, man. I actually enjoyed it, man. Did you enjoy it, man? I enjoyed it.
Yeah, it was good. It was good. Be able to, speak to everybody, see what we could do.
Yeah.
Mhm.
Well, guys, that's all I had for today, man. Guys, if you want to add anything, man, before we bounce, big dog.
Nah, man, we went through a lot today. Man, appreciate y'all. Every week, man, same time.
Guys, again, thank you so much for your trust and your time, guys. You're taking time at 5 o'clock on Friday to listen to Little Old Us, guys. We pray we actually added value to you guys. And those that are on Instagram, guys, don't worry, we get that solved as well. We're all going to begin a private channel. So when we actually go live, you're getting an alert that we're going live on all the platforms, guys. All right, guys. Well, guys, you know, we end it every single time, guys. Every time we do this, guys. Before you leave, and while you can, you see that thing, guys, take that damn picture and give it to your mom and them, guys. Thank you for your time, and holla at your partner. See you next week. Peace.
God give thanks. Bless God give thanks. Bless God give thanks. Bless God give thanks. Big God, big grace.